Let's talk about the accounting cycle. The accounting cycle is our accounting routine by which we keep track of what happens to our business and which allows us to create our financial statements. If we're talking about a corporation, the financial statements that are a product of the accounting cycle are the income statement, the statement of retained earnings, and the balance sheet. By way of example, here are the three financial statements for Freddy's Auto Service Inc. for the month of June. The income statement is their report card. Did they make money or did they lose money? It's revenue minus expenses to give them net income. Did they keep that money in the corporation or did they return it to their shareholders in the form of dividends? We learned that from the statement of retained earnings. Retained earnings at the beginning plus net income minus dividends gives us retained earnings at the end. And the balance sheet is a snapshot at a moment in time. The income statement covers a period. It's a report card for that period. The balance sheet is a snapshot at a moment in time. What do we own? Those are assets. What do we owe? Those are liabilities. And the difference between what we own and what we owe is our equity in the business. In a corporation, we call it shareholders' equity. The first step in the accounting cycle is to analyze the situation to see if there's something for us to record. We don't record everything that happens to our business in our accounting records. For example, Freddie, president of Freddy's Auto Services, rescues a motorist on the freeway during rush hour traffic. He's on the news, he's a big hero, that's good for business, but there's no way to know exactly how good it is. If we cannot measure it reliably in dollars, we don't record it. And if there is something that happens to the business that can be reliably measured in dollars, we go to step 2 of the accounting cycle and record it. We record it using journal entries. Journal entries involve debits and credits. Debit means left, credit means right. One isn't good, one isn't bad. Debit means left, credit means right. Our rules are assets increase with debits, liabilities and shareholders' equity counts increase with credits. And shareholders' equity increases with revenue, so revenue is recorded with credits, and decreases with expenses and decreases with dividends. So expenses are debits, expenses are debits, expenses are debits, and so are dividends. For example, Freddy's Auto Service sells $50,000 in common stock to new shareholders. We put the date of April 1st. We debit cash for $50,000. Cash is an asset. It increases with debits. We come down the line and we indent and we credit common stock for $50,000. Common stock is an equity account. It increases with credits. Once we've recorded all the transactions that happen to us over, say, the course of a month, we have everything in chronological order, but that's not very useful. We reorganize that data in step 3 of the accounting cycle when we summarize things in the T accounts. T accounts represent our general ledger accounts. Every account, like cash, like accounts receivable, like accounts payable, like common stock, will have a ledger account, and we use the T account as a shorthand representation. For example, if this were our first transaction for Freddy's Auto Service, and we debited cash for $50,000 and we credited common stock for $50,000, we would copy that $50,000 debit into cash, and we would copy that $50,000 credit into common stock. To strike a balance in a T account, we add up all the debits and add up all the credits and offset them against each other to find out what our balance is in a particular account. The next step in the accounting cycle is to prepare a trial balance. This first one we do is an unadjusted trial balance. We list the balances in all our accounts in a very special order. Assets, liabilities, equity accounts, revenue, and expenses. I put the equity accounts in blue font and the revenue and expense accounts in red font to help us remember that special order. Assets, liabilities, equity accounts, revenue, and expense accounts. And if we've done everything properly, all our debits equal all our credits. That's why it's called a trial balance. Please note that there's not a debit number and a credit number next to any account. The number that's next to the account is the balance. After we offset all the debits against all the credits, we have a cash balance of $36,800. In this example, our debits equal all our credits, so we can move on to the next step. We could create financial statements from the unadjusted trial balance, but they wouldn't be very meaningful or accurate. First, we have to make our adjusting journal entries. We have to analyze our transactions and determine which of them require adjustments at the end of the month or at the end of the year, depending on how often we do adjusting journal entries. The reason we need adjusting journal entries is because we want to book revenue when it's earned, when we've satisfied performance obligations, and we want to book expenses that match when that revenue is earned. And those things don't always happen when cash changes hands. For example, on June 1st, Freddie's Auto Service signs a lease for some office space, and the landlord wants $1,000 a month, but all 3 months of the lease paid up front. So they debit prepaid rent for $3,000 and credit cash. Why not debit rent expense for $3,000? Because we cut the check on June 1st. If we booked rent expense of $3,000 on June 1st, it would look like the rent was $3,000 for June, 0 rent for July, and 0 rent for August. So we debit the asset prepaid rent for $3,000. We credit the asset cash for $3,000. Then we get to the end of the month and it's time to make an adjusting journal entry. We debit rent expense for $1,000. That's the rent for June. Expenses are debits, expenses are debits, expenses are debits. And we credit prepaid rent for $1,000. So now we've got our rent expense of $1,000 for the month of June, and the balance in our prepaid rent account is down to $2,000, representing the prepaid rent for the months of July and August. So we make our adjusting journal entries. Now we prepare another trial balance, but this time it's called an adjusted trial balance because we've made the adjusting journal entries. It's really important that it be in the same order: assets, liabilities, equity, revenue, and expenses, because we're going to use these account balances to create our financial statements in the next step of the accounting cycle. Creating the financial statements from the adjusted trial balance is a very mechanical process. We start at the bottom. Revenue minus expenses gives us net income. Retained earnings at the beginning plus net income minus dividends gives us retained earnings at the end. We copy the balances from the top of the adjusted trial balance to fill in our balance sheet accounts, except we use that number from the statement of retained earnings as the balance in our balance sheet account called retained earnings. And that's how we create the financial statements. And then at the end of the accounting period, we have to close our books. Revenue, expense, and dividend accounts are all temporary accounts. They're counting buckets that have to be emptied out at the end of the period so we can start counting again. We're going to close those into retained earnings. We're going to take our revenue accounts, which have a credit balance. We're going to debit them for their balance. In this case, for Freddie's Auto Service, it was $7,500. So we're going to debit the revenue accounts and credit retained earnings. We're going to credit all the expense accounts. They all had debit balances because expenses are debits, expenses are debits, expenses are debits. So we will credit them for their balances and debit retained earnings. And then we will do the same thing with the dividend account. It had a debit balance, so we'll credit it and then debit retained earnings. So retained earnings at the beginning plus net income minus dividends gives us retained earnings at the end. And that's the closing process. After we close our books, we perform a post-closing trial balance. There should be no balance left in the dividends or the revenue account or any of the expense accounts. If we perform a post-closing trial balance and there is a number left in here, we know we've done something wrong and we have to go back and start over. Once we're done with the post-closing balance, we start our accounting cycle all over again with step 1.